Hey everyone, it's Jennifer with HomeSmart Evergreen Realty. Let me introduce myself real quick before we get started. Again, my name is Jennifer, and as a realtor, my goal is to make sure that my clients are happy. And also, I strive to ensure that the home buying process is fun, easy, and stress-free. And being a first-time home buyer specialist has given me the opportunity to not only help future home buyers find their new homes, but also educate them on the home buying process to make sure that they're making the right investment. So today I want to share some financing options for first-time home buyers, and I'm very fortunate to have with me Dona Ellena from Springboard Home Loans, and she is going to give us an overview of the basic things you need to know about financing, and also give us an overview of the loans that are available to first-time home buyers. So sit tight, relax, and enjoy this time to learn more about how you can finance your home the smart way. So Donna, take it away.
Thanks, Jennifer. Thanks for having me. Hi, everybody. My name is Dona Ellena with Springboard Home Loans. A little bit about myself. I've been originating loans for over 23 years now. I personally have been with Springboard for a little over 2 years now. And one thing I like about Springboard is we concentrate our efforts in that first-time home buyer market. So we offer programs that are available to first-time home buyers almost exclusively. We also do traditional loans, but we do wrap our brain around the down payment assistance programs and such. So I'm going to tell you a little bit about the different programs that might be available to you. And we're going to start with a little bit about the different types of loans out there. So from the get-go, FHA has always been kind of touted as the first-time home buyer program. It is not necessarily only first-time home buyer. It's not necessarily only available to first-time home buyers, but it's a great program for that first-time home buyer because of its low down payment requirement. However, a lot of people don't realize that Fannie Mae and Freddie Mac both have their version of a first-time down payment, low down payment program available to you. Sorry about that. Fannie Mae and Freddie Mac both offer a 3% down loan to their first-time home buyers. They typically, unlike FHA, will require a little bit better credit score, possibly a little bit lower debt-to-income ratio, so a little more restrictive requirements, but still a great alternative to that FHA loan. So a little bit about the mortgage process. A lot of people don't realize, but the mortgage process includes 3 different distinctive parts. The loan originator is the one you're probably most familiar with. The loan originator, myself, are the people who work directly with the home buyers. We gather your information. We determine whether you are pre-qualified for a purchase. Once you find your home, we take in your documents and we get your file underwritten. We get it funded and you get it recorded and you get your keys. So that is our job. But what happens after the fact is important too. So once your loan closes, it goes to 2 different split in 2 different forms. One is the servicer. So the servicer is the person who bills you monthly. They take your payments in. They service your loans. They're there for questions that you might have, so you can communicate directly with them. They would also be responsible for the foreclosing part of your loan should you default on your loan. Then you have the investor. So we all answer to the investor. The investor is the person who set up the guidelines for your program. They insure, in many cases, insure the lender who originated your loan against default, which is great. They get paid from the servicer based off of your loan. You're making your payments. So they kind of dictate what goes on in the market as far as what our guidelines are for approving people. They look at the overall credit risk of a file and determine borrower's eligibility guidelines. So in the origination realm, there are basically 3 to 4 different types of originators out there. There are what's called a mortgage banker. So a mortgage banker is not a bank. They're not a wholesale lender. They are a company that is set up to originate your loans. They also have the ability to fund and underwrite and fund your loan. And then they oftentimes will sell these loans off on the secondary market to an investor. Okay. Unlike a mortgage banker, you have the banks. So the banks are what they call portfolio lenders. In addition to doing all the traditional type of financing out there, your FHA, your conventional, your VA, they also may do jumbo loans, which they make up their own rules to those loans. They decide what the qualifying criteria is. And they are not only the originator, they are also the servicer and the investor. So it's kind of a one-stop shop. They do everything themselves. They too can sell loans off after the fact, but oftentimes banks are big servicing entities. They service your loans as well. Savings and loans are very similar to a banking relationship. They also do originate and underwrite, fund, and service loans. Mortgage brokers are a third-party originator. So we are, in a nutshell, the middleman. We don't underwrite our loans, we don't fund our loans, but we do originate them, and then we shop around to find you the best deal out there. We're regulated just like everybody else, but we work as a mortgage broker. We are working directly with the lender, who is the one who ultimately may service your loan. They may or may not, but they are the ones who definitely will underwrite and fund your loans and make sure that we have fulfilled all of the investors' requirements. We are all in all these cases, we are all licensed by the federal government to be able to do loans. Okay, secondary mortgage market. You may not know a lot about this part of the business, but these are the powers that we all answer to. So Fannie Mae, Freddie Mac, and Ginnie Mae, they work with the lenders out there, and they insure those lenders against loss on mortgage defaults. They also play a part in freeing up cash for the lenders to lend in the form of buying back what we call mortgage-backed securities and such. A little more complicated part of the business, but these are the folks that establish the guidelines that allow us to originate loans and protect the lenders so that they can do so. Ginnie Mae is FHA's guarantor, by the way. So let's talk a little bit about what specific types of loans may be available to you as a first-time home buyer. So we mentioned earlier Fannie Mae. So Fannie Mae is a conventional loan entity. And some of the loans that are available through them for the first-time home buyer or low down payment loans are the Home Ready loan. Home Ready is a 97% loan-to-value mortgage. That means you come in with 3% down. This program is available for both a first-time home buyer and a repeat home buyer. You don't have to be the first-time home buyer. As I mentioned, as little as 3% down. One of the nice things about this type of loan is it allows you to add a down payment assistance program to it. So it will allow you to go up to 105% combined loan to value. So that's 105% of the purchase price or appraised value of the home. In the form of a community lending second, which can technically cover all of your down payment and all your closing costs. This is eligible on every type of majority of every type of product or purchase homes out there. Your manufactured housing, your single family, which is just a regular house, condo, your townhomes, all of those types fall into this category. There is income limits on this program. They are 80% of what they call the area median income, and there's a very nice lookup tool on the internet from Home Ready that will allow you to determine what the income limits are based off of the county that you're looking in. Fannie Mae, in addition to the Home Ready product, also offers a standard 3% down program. On this program, the one criteria that they do have is that one of the borrowers must be a first-time home buyer. However, there is no income limits on this program. They do not require home buyer education. Home buyer education is required on Home Ready. And their guidelines are a little more like their traditional guidelines. They're where Home Ready has some little caveats within it that allow for things like border income. If you have somebody who is living with you that pays rent, and we can properly document that, you potentially could use that as income towards your purchase on a Home Ready loan. Your mortgage insurance would be potentially a little bit higher on the standard 97% loan versus the Home Ready. The interest rate would be higher than the Home Ready loan. The Home Ready gives you a little bit of a break on the interest rate, so it's a great loan for you. Fannie Mae also offers what's called a home style renovation mortgage. This will allow you to buy a home that may be a fixer-upper and include some of the repairs within the purchase price. They actually will base the value and your loan to value on the fully completed renovation value once the repairs are completed, and works on your regular properties, second homes, etc. So conventional loans for first-time homebuyers from Freddie Mac. Freddie Mac and Fannie Mae are kind of sister companies. They both kind of do the same thing, have similar guidelines, similar programs. Freddie Mac's version of that Home Ready is called Home Possible, which is also 3% down loan, does allow for a down payment assistance, second lien, up to 105% combined loan to value. Works on regular properties, no manufactured homes on this particular loan. They do have some credit score restrictions if you're doing a manual underwrite. Otherwise, the credit score requirement will default to what the automated underwriting is. Both Fannie Mae and Freddie Mac have a minimum credit score of 620. However, a lot of the lenders out there, investors out there, have higher credit score requirements depending on the market and everything that's going on. Does require owner occupancy, and your funds on those loans. Let me go back here a little bit. Sorry about that. Your funds for your down payment and closing costs literally can be zero on these loans. You can have a second lien for down payment and closing costs. You can get gifts from family members. We have some programs that offer grants where we can give you money for down payment and closing costs that's forgiven after a 5-year period. So some great programs out there should you qualify. So FHA, as we said earlier, FHA is great for first-time home buyers. However, you don't necessarily have to be a first-time home buyer. So what FHA does a little bit different is they're a little bit looser on the credit score requirements. They will go down to as little as 500 on a credit score. However, again, take into account most investors will have some credit score restrictions that may bring that credit score requirement up to 580 or better. They do require 3.5% down on their loan. They do have mortgage insurance that might be a little bit higher than the traditional conventional loans. However, given that they're going to allow you to get into a home with maybe credit that's not exactly perfect, it's a great option. They have their version of the fixer-upper loan. They have two versions of it. They have what's called a full 203K, and then they have a 203K streamline. Basic difference between the two is a regular 203K will literally let you build a house from the foundation up. As long as the foundation was there before, you can do the renovation loan. This requires contractors, bids, inspections, etc. The 203K streamline is more of that little home improvement projects, goes up to a maximum of $35,000. for home improvement. This would be used in case where maybe you wanted to update the kitchen appliances and do stuff like that. So paint, carpet, it's more of a mom and pop type of streamlined program. Okay. FHA and VA has this as well, but FHA has what we call an energy efficient mortgage program. This allows you to upgrade energy efficient standards and within the home that you're purchasing and include the costs of those renovations in the loan. So if you own a home or buying a home that, let's say it was built in 1940, has old windows in it, well, new improved windows are a whole lot more energy efficient and potentially could be financed into your loan based off of what the improvement standards would bring to the home. You also can finance in solar panels and stuff like that. That is proven to be include energy savings. There are some inspections and stuff that are done around this loan, so be wary of that. But you can definitely finance in those home improvements. One of the things that makes FHA a little bit different from conventional, as we mentioned earlier, are the credit standards. So FHA is a little more lenient when it comes to your bankruptcy timeframes as well as your foreclosure timeframes, or what we call serious derogatory events. Chapter 7, Chapter 11, which are your two normal bankruptcies, they only require a minimum of 2 years. Chapter 13, which is kind of it's the realignment of debt on a bankruptcy, only has to be 1 year. So a little more lenient for there. In any case, with any significant derogatory event, we want to see a reestablishment of credit. We don't want to see lates after a BK. That can be a major issue. But we're willing to work with you on your credit and discuss some ways that you can improve it as well. Foreclosure or short sale or deed in lieu of foreclosure, which we've seen under the last crisis, we saw quite a bit of that. FHA will allow you to finance after 3 years, which is great. So not out of the market forever. Okay. In California, there is a down payment assistance program that's good throughout California. CalHFA is one of those programs. CalHFA offers a first, a second, and actually a third mortgage at 0% interest that allows you to provide your down payment and or closing costs, or part of your closing costs within the loan. It's a great program. There are income limits on it. However, they're extremely liberal. And they do this program both conventional and an FHA version. Each has its own set of guidelines. So if this is a program that you might be interested in, we definitely want to chat a little bit about it. You can give me a call. But they also have a VA version, albeit VA does offer 100% finance, and we'll talk about that here in a second. There are some special provisions if you are a government or a school teacher in public school as well. So here are some program guidelines. You do have to be a U.S. citizen. They do have some minimum credit score requirements right now, 660 to 680, depending on the type of loan. They do require home buyer education, which can easily be obtained through a housing counseling agency and or online in some cases. The down payment assistance program, as I mentioned earlier, does include down payment or funds for down payment as well as majority of your closing costs. One of the great loans out there is a VA loan. So if you are a veteran or in the military, you may have access to a VA loan. One of the best things about the VA loan is it does offer up to 100% financing based off of your entitlement. If you're a first-time user of your loan, you most likely have full entitlement if you have honorary discharge and have been in the military normal times. One of the nice things about the VA loan now is there really is no income limits for the program, and there is no purchase price limits for the program. So you can get 100% financing pretty high loan amounts. VA does not require a monthly mortgage insurance, which is awesome. They do, however, have a funding fee that they have on the loan, and depending on your service level and whether you have a service-connected disability or not, you may or may not have to pay the funding fee. However, the good news is the funding fee is financed into the loan. If you happen to be putting a down payment on your VA loan, that funding fee can be reduced depending on the amount of down payment. And one of the big misnomers with the VA loan is people think if they use it one time, they don't have to use it again. They can't use it again. That's wrong. You absolutely can reuse your VA loan over and over and over again. You just can't have multiple VA loans opened at one time for exceeding your entitlement amount. Sometimes you may have heard the term a VA no-no. A VA no-no is a loan that has no down payment, which VA loans have no down payment, and all the closing costs are paid by the seller. So that's a negotiable part of the VA loan, where VA allows the seller to pay all your closing costs, and you would negotiate that through Jennifer through your purchase. There's also another loan in California for our veterans called the CalVet loan. CalVet is a little bit of a unique product. It is not funded through the Veterans Administration. It is funded through state bonds and available to veterans who are residing in California. So there are there are purchase price limits on the loan. They do not allow down payment assistance or secondary financing. And they do not allow secondary financing ever on the loan. So you can't get a line of credit or anything after the fact on this type of loan. This loan comes in handy when interest rates on your standard VA loans are on the high side. Right now they're great, so this isn't necessarily the best loan that I would use right now, but we always check it out to see what their rates are doing, and to see if it's a good alternative for them. They do offer a couple of unique options, and they also have some programs that do require a down payment. So we can take a look at that if you are a California veteran and see which would work best for you. USDA. USDA is one of those loans out there that you don't hear a lot about, but it's a great loan if it fits your guidelines, or if you fit into the guidelines. So USDA is United States Department of Agriculture. It is a conventional loan, but it's designed for rural areas only. So if you are looking to purchase in outlying areas, and there are quite a few in California, Southern California, it's a great loan. It is 100% financing, 30-year fixed rate. There is no mortgage insurance on this program. However, they do have a guarantee fee, just like the VA does, that can be added to the loan. There are income limits as well as purchase price limits on this program. And there is an online website where you can go in and find out if the home you're looking at is eligible or is in an area that is eligible. They do require a 640 minimum credit score. And the income limits, as I mentioned earlier, they're rather liberal for the area. One of the unique things about the USDA loan that we don't have with any other loan that I'm aware of anyway, is their 100% financing is based off of the appraised value. So let's say you're out there, you're buying a home that is $300,000 and the appraisal comes in at $310,000. You could actually finance up to $310,000 and include closing costs in that financing. Only loan of its kind that I'm aware of that does that, so it's a great option. So with that, Jennifer, I'm going to shoot it back over to you.
All right. Thank you, Donna, for sharing all these information with us today. Well, folks, thank you for watching this video. I hope you guys learned something beneficial, and feel free to reach out to me and to Donna if you guys have any questions. And more importantly, please reach out to me whenever you're ready to get started with your home buying journey. Again, so stay safe, everyone, and be healthy, and we'll see you soon. Bye.
Bye.